All right, it's Jobs Wednesday, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
An absolute blowout of a jobs report. January payrolls doubled the estimate, and the unemployment rate unexpectedly fell.
And that strong data gives investors some relief as markets still punish companies seen on the wrong side of AI.
And more earnings roll in with results from Ford, Kraft, Mattel, and others, giving investors a fresh read on the consumer.
It's a bit of a weird one. Consumer maybe isn't spending as much, but jobs are plentiful. It's a confusing picture, and maybe as part of that confusion, Kraft Heinz is changing one of their game plans. I'm looking at the shares this morning, down 6.8%. The CEO saying that they will not be splitting into two publicly traded companies this year. Steve Callahan wants to focus on profitability, invest $600 million into marketing, R&D, and select pricing. I should also say Warren Buffett hated that they were splitting up. So that could have played into it, too.
Well, he put them together, right? The Ford Motor Company expects its profit to jump this year despite a surprise $900 million tariff bill at the end of 2025. The company plans to increase capital spending to as much as $10.5 billion. Another positive driver, Dani, really for the U.S. economy.
Yeah, there's a lot to see today in terms of positive drivers, and there's the big one. The U.S. adding 130,000 jobs in January. That is double the analyst estimates of 65,000. The unemployment rate unexpectedly ticked down to 4.3%. Traders have now pushed back bets on a Fed rate cut from June to July. Let's bring in White House acting chair of the Council of Economic Advisors, Pierre Yared. Pierre, thank you so much for joining. Right off the bat, one of the things we're trying to square is Kevin Hassett, the NEC director, saying to expect weaker jobs. And then we get this blowout report. How do you reconcile the two?
Great. Thanks so much for having me. It's a pleasure to be here. You're absolutely right. It's a blowout report. It exceeded almost every single forecaster out there, I think, except for two. And not only is it total jobs that are up above expectations, it's also private sector jobs. That are at 170,000, so more than, or 160,000, which are more than double expectations. I think the way to think about, the way we were thinking about it is if you look at demographic changes as well as the big reduction in immigration relative to, in particular, illegal immigration relative to what was happening under the Biden administration, those two factors should lead you to lower break-evens, and that's consistent with, what a lot of forecasters have put out there. So given that you anticipate lower break-evens, it's even more remarkable to get a job number that is that strong.
Yeah, I mean, the fact that we are looking at unemployment at 4.3% and, adding double the amount of jobs that Wall Street had anticipated makes me wonder about rate cuts. I mean, are they really necessary here when the labor market seems to be doing fairly well and inflation is still a huge problem for consumers?
Well, listen, when you look at inflation has been trending down. It can be volatile for months.
But it's still high on top of already high numbers. I mean, we're adding insult to injury here, so...
If you look at 3-month inflation rates, it's very low. It's within the normal ranges. So, and if you look at the trend lines, it's been low. Now, I don't know where it's going to come out on Friday. It could be that there's some seasonal adjustments because of a very cold January. But overall, you see inflation trending down. The Fed does have to balance its dual mandate, and it's got to be consistent with what its strategy review instructed it to do, which is to focus on the type of job growth and the type of labor market that's consistent with its inflation
I think part of the concern, and Matt was getting at this too, is that we clearly have a strong jobs market, and even if inflation is trending down, it's not at target. And then you have the president of the United States saying that if the new Fed chair does his job, we'd have growth at 15%. All of that feels like a recipe for inflation. So is it a mistake then to be pressuring this Fed to move away from a focus on inflation?
The Fed should be the forward-looking, not backward-looking. So when you're looking at inflation, you shouldn't just be responding, or jobs, you shouldn't be responding to what's happened in the past. You should be looking at what's going on in the future. So if you look at what's going on in the future, it does look like we have significant productivity growth. So in the face of significant productivity growth, that puts downward pressure on inflation. The president's supply-side policies, deregulation, tax incentives for investment, All of those factors lead to significant productivity growth, not to mention the big explosion in AI. So in the face of productivity growth, which we haven't, this type of productivity growth may be reminiscent of the type that we saw in the 90s. That would be disinflationary growth that's consistent with a healthy labor market. And so that's what the Fed should be thinking about.
All right. I mean, the prices consumers are paying are still a problem. Affordability is still a problem. But let's put that aside if you don't recognize it and focus on the labor market. The labor force grew by 387,000 in January. And I thought we would see the labor force shrinking because of immigration policy, mass deportations. What do you attribute that growth to?
If you want to look at the labor force over time, I think the best way to look at it would be in terms of the census, because month to month it's going to be a little bit difficult to assess this using the household survey. So over the past year, what we do see is that relative to trend, the labor force growth or the population growth has declined, and that's consistent with the evidence that we got from the census. So according to the census, we had relative to trend something like 300,000 fewer lower population, and so in light of that, you would anticipate that should continue into the next year.
Pierre, if you look at where the job growth came from, 82,000 jobs from healthcare, social assistance increases 42,000. That's 95% of the jobs that were added in the past month. This is a non-farm payrolls that was virtually all growth coming from healthcare and social assistance. It's a trend that we've continued to see because of demographic changes. But does that mean that this growth is less healthy if it's really only being held up by one industry?
You have to consider the base when you do that kind of analysis. Most of the jobs that we have in this economy are services. So on a proportional basis, that's the right way to think about it. So on a proportional basis, those are growing, but you would anticipate larger absolute values given that it's a larger portion of the economy. And as you mentioned, if you have an aging society, it would be natural that we would get a little bit more employment growth in healthcare.
By the way, manufacturing added jobs. We got 5,000 new manufacturing jobs in January. After a string of losses, fair to say last year wasn't great for manufacturing. Are we going to start adding more manufacturing jobs to this economy as the president's policies take hold?
Let me talk about construction, then I'll talk about manufacturing. In terms of construction, we saw significant increases in construction over the past month, especially if you look at non-residential construction. That's consistent with the president's economic policies. So because of these economic policies that are there to drive investment and factories in the economy, you saw an increase in construction jobs. If you look at what we should anticipate more manufacturing jobs as a consequence. But if you look at manufacturing holistically, you can see that manufacturing value added, the growth in manufacturing has been very strong. In addition, if you look at manufacturing productivity, that's been very strong this year, and then that's been reflected in significant growth in manufacturing wages. I mean, one thing about the report, of course, is that the report showed that average hourly earnings, weekly earnings, those are up, and they're up across the board, and they're up in manufacturing.
Pierre, we also had government jobs falling again. How many more do you anticipate? Do you think that this trend will continue of government jobs coming off?
I think what the administration wants to do is to ensure that the government is right-sized. And when you look at where the government is right now, we're at the lowest level of federal government workers since 1966, which is quite remarkable. And what's true is that there's significant waste, fraud, and abuse, and we need to right-size the government and ensure that all of our workers in the economy are put to their most efficient use. So when you have government workers that lose their jobs, they're reallocated towards the private sector. And what's been remarkable is that even after the QCW revisions, you see that you've got 615,000 private sector jobs in the economy. And that's the way to grow the economy, to ensure that everybody is put to their best use.
All right, Pierre, great to get some time with you. Really appreciate you joining us this morning. White House Acting Chair of the Council of Economic Advisors, Pierre Yared, talking about the jobs blowout. 130,000 jobs added in the month. You can see here futures are responding well. S&P futures up this morning 0.6%. NASDAQ futures gaining 0.8%. So it's interesting, as yields come up, there is less of a bet that rates will be cut or won't be cut as soon, right? We were pricing in a full rate cut by June. Now that's pushed out to July, but stocks are still responding positively.
Yeah, I guess we flip back to good news is good news, bad news is bad news. We saw that earlier this week, for example, with the retail sales data too. Matt, some of the individual companies that we're looking at this morning, Spotify, they beat estimates across the board in the Shopify was yesterday. Shopify beat estimates in the fourth quarter, except for operating expenses. It's also authorized a $2 billion share buyback, shares up 12.33%.
Humana's profit forecast fell short of estimates, with earnings guidance more cautious than normal to account for this dynamic environment, and it sure is.
That maybe is an understatement. Mattel holiday sales fell short of estimates, and its outlook was on the lower end for profit. Shares could fall by the most on record if this, a nearly 30% loss, holds. What happened in December? We're going to have more on the toy industry in the next hour. Please say we're going to be speaking to the Hasbro CEO, Chris Cox.
Yeah, Mattel could use a little magic, and Hasbro has it, at least in terms of the gathering. We'll ask Chris Cox about that. Coming up, Kraft Heinz is putting its separation into two publicly traded companies on hold. As Dani told you, we're going to give you the details next. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Ukraine President Volodymyr Zelenskiy says his country will join new U.S.-hosted peace talks next week, with territory as the main sticking point. A proposed free economic zone in Donbass faces skepticism from both Kiev and Moscow. He says the war could end within months if talks move in a good direction, but any deal must be approved by Ukraine's parliament or voters. President Trump is privately weighing whether to withdraw from the U.S.-Mexico-Canada agreement, the trade pact that he negotiated in his first term. The deal faces a mandatory review by the 1st of July. An exit could disrupt $2 trillion in trade and trigger tariff hikes as talks with Canada and Mexico grow increasingly strained. And the Ford Motor Company says profits could rebound to as much as $10 billion in 2026, despite a surprise $900 million tariff hit that doubled its trade costs at the end of last year. The automaker is leaning on strong pickup and SUV demand, cost cuts, and slimmer EV losses, even as aluminum shortages and trade policy volatility pressure margins. Let's talk about Ford with Bloomberg Autos reporter Keith Naughton in Detroit. And Keith, I can just imagine being CFO Sherry House when the administration says, oh, by the way, you actually owe us an extra $900 million in tariff costs. What happened there?
Yeah, so on December 15th, when Ford was announcing that big write-off on its EV business, they also raised their guidance and said they'd make $7 billion earnings before interest and taxes in 2025. Then a week later, on December 23rd, the White House tells them, you know, that break we gave you on tariffs, it only starts on November 1st, not May 1st, as you thought. That was a $900 million difference. And suddenly the tariff bill for Ford doubled to $2 billion. They missed their EBIT target. They missed their adjusted earnings target. The fourth quarter ended up being far worse, and it was already looking bad to begin with than they had expected.
It's one step forward, two steps back. The step forward being the elimination of these cash penalties to meet different fuel economy metrics. And they're trying to pump out more SUVs, more pickup trucks. Keith, how has that project been going for Ford?
That's great. And they are trying to, crank out the V8 engines and big SUVs like the Lincoln Navigator and the Ford Expedition, which they're doing. They're having record sales with those. Where they lost production, it was with the F-Series pickup trucks that were affected by a fire last fall at a supplier in upstate New York. So they are getting that production back up. They're adding pickup truck production. This is Ford's most profitable product line. So they're really trying to boost that. And that's why they're forecasting earnings to increase to $8 to $10 billion before interest and taxes this year.
Hey, Keith, thanks for that latest on Ford after their earnings. That's Bloomberg's Keith Naughton in Detroit. Elsewhere in earnings, Kraft Heinz is pausing work on its planned separation as the new CEO works to improve the business. Let's discuss with Bloomberg's Red Brown. Red, what did the CEO say? What was the thinking behind not going forward, at least for now, with the separation?
Yeah, I think right now what they're seeing in the business, and you can see kind of in the fourth quarter earnings results, is they need to get the business in a stronger position before they can kind of execute this plan and feel confident that that when they do split, they will be, two standalone entities that are able to kind of live on their own and be profitable. But we can see after, 4 straight quarters of double-digit declines in earnings that right now they're still not there. There's still more investment needed to be making to the businesses, grow market share again, and then kind of contemplate moving forward with the split.
Why are they looking at these declines in earnings? I mean, are they having, like other companies, tariff costs that they're not able to pass through to the consumer?
Yeah, so it's definitely like a pricing issue, right? So they have been higher priced than some of their competitors. That's definitely probably weighing on their results. We can see volumes are declining as well, which always is kind of a worrying sign for these consumer packaged good companies. So they are right now saying that we need to invest in price. We need to invest in R&D. We need to start getting products in front of customers that they're going to resonate more in formats that resonate more. So they're definitely kind of struggling through the higher pricing and the demand environment at the moment.
Do you think Berkshire Hathaway and Warren Buffett have anything to do with this pause? Because Warren Buffett was very vocal, saying that he did not agree that this split up should even happen.
Yeah, I don't know how much they had in influencing this. Obviously,
who listens to Buffett, right?
Yeah, right. We did see Berkshire starting to unwind their position earlier this year, right? So I think kind of a vote of no confidence into this move. So clearly that's the most prominent investor in the combination, now saying that backing away once the split was announced. So I do think that there's probably people, like you said, Matt, people do listen to Berkshire and Buffett. So.
Yeah, absolutely. The Oracle of Omaha has a say. Red, thanks very much. Red Brown there covers these companies for us on the BN side. Now, Robinhood reported lower fourth quarter profit due to sharp declines in Bitcoin and other cryptocurrency, I'm guessing prices as well as trading. Paige Smith, Bloomberg consumer finance reporter, joins us to talk about this. And Robinhood is a stock, this is why I care, that's been absolutely on fire. I mean, it's unbelievable, the growth in this valuation, but it's come to a screeching halt today.
It has, and I think it was really interesting kind of listening to what the executives highlighted on the analyst call last night, which really was, there were a lot of questions on crypto. There were a lot of questions also on prediction markets, which are certainly the talk of the town in the retail investing space. And when it comes to prediction markets, Robinhood is sort of emerging as a leading contender, kind of a go-to platform for a number of consumers who wish to kind of engage in this sort of wagering.
How reliant then are they on crypto? Because if they're becoming one of the top players for prediction markets, also retail trading has just boomed. I mean, the stock exchange's volumes are now dominated by retail traders who presumably a lot of them are using Robinhood. So why aren't they more diversified?
So I would push back on that a little bit. I would say that as a company, Robinhood certainly is diversified. However, there were a number of sort of key growth businesses that have sort of slowed in growth a bit. Crypto revenues being one of them, for example. So crypto trading dropped 38% in the fourth quarter to $221 million. And, there's a little bit of a slowdown, again, as kind of attributed to some of the drop in digital asset prices. But we will kind of have to see sort of where the company continues to focus. It's always interesting, again, to tune into the calls and see what the key questions are asked and sort of where the executives like to spend their time.
Look at this 5-year chart here. The ride up was amazing, like 400% from the lows, right? But over the last 6 months, the stock has lost like 40% of its value. What's going on?
I think we still need to watch closely. The executives were kind of hitting tones of optimism for the rest of the year. We are just in February. I think we kind of need to take a minute and see where the stock goes for the rest of the year.
Yeah, I mean, still up 60% in the past year, but it would just be bad if you bought in that October peak.
Yeah,
there.
if you bought it in October.
That would hurt.
Yeah.
Yes, definitely. Paige, thank you so much for joining us. Always appreciate your time. That's Bloomberg's Paige Smith. Still ahead on the show this morning, strategist Katrina Dudley joins us as the trading day gets underway after a blowout jobs report. She says that equity markets are being supported by solid earnings growth and a Goldilocks macro environment. That conversation coming up soon. Stay with us. This is Bloomberg. 6 minutes to go until the opening bell. It's a rally underway, turning around from a negative day yesterday thanks to a jobs number that beat everything but I believe 2 estimates, double the consensus among economists. A 0.5% gain is where we stand on the S&P 500. The future session trades at 7,000. We'll see if we can get there. On the equity market, on the cash trade, NASDAQ, that outperforms, up 0.7%. You'd probably assume small caps would outperform too, and they are this morning, up 0.8%. As yields move higher, Matt, we are now no longer pricing in a June rate cut, but instead that moves to July.
Yeah, it's interesting to see, these moves. Investors, we're pushing out rate cut expectations. And investors are selling treasuries, I guess, because they, don't expect the Fed to cut sooner. But you have some weakness in the dollar. You have gains in equities. Let's get a look at some of the other movers on our radar. Activist investor Ancora is said to have built a stake in Warner Brothers and plans to oppose Warner's deal with Netflix. You can see Warner up, Netflix up, Paramount up. So it doesn't look like any differentiation in reaction there.
That's true. Maybe this doesn't move the needle that much. Elsewhere, Elliott, speaking of other activist investors, has built a stake in the London Stock Exchange. It's grappling with disruption from artificial intelligence and a plunge in listings.
Lyft is plunging in price as its global expansion is not progressing as expected despite bookings for the fourth quarter beating estimates. You can see Lyft down 16.5% in the pre-market.
And then there's power and cooling equipment maker Vertiv. It is surging as orders jumped 250% in the fourth quarter on strong demand from, as you might guess, hyperscalers. Those shares are up 15.4%. Less than 4 minutes to go until the opening bell and what's set to be a positive day. Katrina Dudley will discuss the economy and which sectors could be the next targets of AI. Stay with us. This is Bloomberg Open Interest.
We are moments away from the start of trading on this Jobs Wednesday. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures up across the board as the jobs number clobbered expectations. We added 130,000 jobs in January. The expectation was for half that, 65,000. The whisper number was even lower, so much better than had been anticipated. You hear the opening bell and see the guys. It's Marciano Tesla, the founder of Agibank, AGI. It's a Brazilian fintech. I would say Brazilian banks are hot right now because we have seen a couple come to market here in the U.S., but they're not so hot because they originally wanted to offer 44 million shares. They had to cut that down to 20 million shares. And they originally wanted to sell them for $18 a share, and they had to cut that down to $12 a share. So you got there. At least you got there. That's the important part. You're playing now. Solve Energy here. You can see Mr. Hirschman there, CEO, ringing the bell. And they just started trading. And they have a very cool ticker, Megawatt MWH, which we're all kind of learning what a megawatt of power is. How many households could that run?
I still don't think my puny, tiny little human brain can comprehend any of these things. I don't know if I'll ever get the hang of it, just how much power these things generate and how much is needed for AI.
Right, but Manhattan Island, when it's running on a regular basis, needs 8 or 9 megawatts of power.
Yeah.
So to me, that translates pretty easily to about 1 million households, but I don't know.
Well, business is clearly booming. Either way, I think is the takeaway from that. Now, one of the stocks I'm looking at the open is Kraft Heinz. Shares are down more than 4.5%. The new CEO of Kraft Heinz says that the company will not split into 2 publicly traded companies this year. Steve Callahan wants to focus on profitability and will invest $600 million in marketing, R&D, and select pricing.
The pricing is, to me, what's interesting there. Now, Ford expects profits to jump this year. They did have, at the end of last year, a $900 million tariff bill. Of course, that was 2025, so it doesn't have anything to do with profits this year. But they do not only expect to make more money, they expect to spend more money. Capital spending this year is going to increase to $10.5 billion. And that's got to be good news as they claim to be the most American manufacturer I guess Tesla would dispute that, but they're up there, right? A lot of factories, a lot of employees, growing the economy. Joining us now at the desk is Franklin Templeton Senior Investment Strategist Katrina Dudley, and I lead into you on that, Katrina, because of course, the jobs number was absolutely killer today, right? We added 130,000 jobs. We were only looking for officially 65,000, and the whisper number was for 35,000.
And look, we keep telling people we're in Goldilocks equilibrium. Okay, the growth number is not too hot and it's not too cold. I look at inflation, not too hot, not too cold. I look at supportive fiscal, I look at supportive monetary policy, and I look at a reasonably stable unemployment outlook, which means we've got job creation in order to absorb all of those new graduates that people have actually been concerned about. So I think that there's been a lot written in the headlines about the graduates are not getting employment, and that employment number I think is the first big positive indicator we've had here.
What do you make then of yesterday's retail sales data? Do you just put that to the side as an anomaly?
I think in terms of retail, you need to understand that that's disproportionately focused on the lower end consumer. The higher end consumer is obviously has other needs and wants. And if I have a look, I think we are starting to see concerns about that low end consumer. Look at the comments that PepsiCo made on the snack and beverage market. You compare that, however, to what Costco is saying. Costco is a little more of that middle income consumer, and things are going fine. So I think if you're in the middle, upper end consumer, you're okay. But from an overall retail sales number, we've seen a little weakness, and that is driven by the low end.
I mean, earnings are still incredibly impressive, right? What are we looking at? 12% with 75% of the companies in the S&P reported?
Yeah, and that comes off a third quarter, and we've talked about this. You had 18% in the third quarter growth in the Mag 7, but the rest of the market was still growing in like the low teens percentage, and that's what we're continuing to see. And what does that support? It's this going back to it's a goal. We talk about it. I want to say it again: Goldilocks equilibrium and a broadening of this market. And that broadening of the market has so many macro underpinnings that we are just very confident that we're going to see more companies benefit this year than just those 7.
The broadening started and it was everything. And then it's only some things. And tech started to fall, and that's part of the way that the broadening started to happen. Do you anticipate that as this broadening happens, it's not a rising tide that lifts all boats, that tech valuations necessarily need to come down at the same time?
I don't think they actually need to come down. I think that what will happen is that the valuations that will adjust with the earnings growth. So I think that we've had a little bit of concern about that earnings growth sustainability, and that's been driven by the high CapEx numbers and the investment returns. We've been suddenly starting to be concerned about that. But we were talking about it earlier. The difference now with AI, I remember for my entire investing career, you could always predict the losers from any kind of big change in a market. With AI, it's actually really difficult to spot the losers. It's so much more easy to spot the winners. And I think that's what's driven the tech sector. Now I think we're going to start to see some of those winners in the middle part of the market starting to emerge.
I'm going to ask Dan Ives this when he comes on as well, but I wanted to ask you too. How do you think about the shift in these hyperscalers? Previously, if you were investing in them, and Dani's been pointing this out for a while now, they were asset light. They were generating a ton of free cash flow. They were returning it in the form of tens of billions of dollars of share buybacks to investors. Now, it's a totally different investment proposition, right? Because they're generating cash and then recycling that into data centers, and the guaranteed ROI isn't there anymore, and they're borrowing money on top of it. So
you need to have something that protects your moat. Okay, and moats can be protected in multiple different ways. They first can be protected as a network. So where does a network investment happen? It's in your advertising, in your marketing, and spending, to get more people into scale. A moat can also be created through capital. And that's what we're starting to see here is people are saying that, I'm not as trusting in my network moat. I want to give myself a little bit of optionality, and that optionality will come in the form of fixed capital. Does it mean that the returns are lower? I think that people just randomly think that the returns on a network effect are much higher than the returns on actual physical capital, but that's not always the case.
How are you thinking about the SaaS-pocalypse? The end of days for software. I mean, obviously, I'm being very facetious here, but every day does feel like
Slightly
we get
facetious.
Slightly.
Not very.
Yeah, no, that's true. Because every day there's a new press release, like this startup happens, Anthropic has put out this sector sells off, that sector sells off. What's noise and what's actually impactful?
I think where is the value? I mean, the value is in data and in databases and data that you can feed into a system and an ecosystem. We own our own orchestration layer, and so we're looking for partners that can give us our data into that orchestration layer and to then deliver the results to our partnership. So if I have a look at the companies, you want the ones where they've got that data, they're really recognizing that having a user interface of your own that people actually have to go out of an ecosystem to is no longer a competitive advantage and a moat. And if you have been slow to switch to the mentality, they're the types of companies I would be wary of.
Are there any winners that we, that are kind of uncovered or that you can uncover? Because I always think of Reid Hoffman at the Economic Club a couple of months ago was saying he thought radiologists were going to be out of a job because AI was so good at screening for cancer. And it turns out it just made radiologists better at screening for cancer and more people went in for screens.
And that's the same argument we're having with the power companies at the moment. We're saying, hey, you get a new technology, it uses less power or it needs less cooling. But if power becomes cheaper, it becomes cheaper to deliver AI. And if I've got cheaper AI delivery, it means that we're basically going to use it more. That is a fundamental condition. And I think that our use cases for AI at the moment are limited by two things. First, just human attention span. I mean, I've run, our ChatGPT in the pro mode, and sometimes, it's a couple of minutes and everything. So you kind of get distracted and everything. But I think that we're going to see just more people integrating AI into daily workflow. And that's where you want to be looking for companies. It's companies where it's part of workflow. You want to look for the companies that are giving you tangible metrics on how it's impacting. Is it making meeting prep shorter? Is it giving you cost efficiencies in your back office? And I want to say that at the moment, we're so focused on the cost side of everything. I think 80% of AI use cases are currently focused on cost. It's going to be when it shows up in the revenue side. And I'm not talking about you all signing up for AI.com handles, but I'm really talking about it, in different companies, in different industries, AI driving earnings. And I think that's what the next leg of this rally and what we're looking for.
Katrina, we're going to have to leave it there. Thank you so much for joining us this morning.
Great. Thanks for having me.
Great to see you. Katrina Dudley from Franklin Templeton. About 10 minutes into your trading day, let's get a check on your equity market because we are moving higher. Thank you. Blowout jobs numbers higher by almost 0.5%. Breadth, though, pretty even, just slightly more on the upside to the downside. We're looking at percent change. I wonder if in the control room we can change this to points.
Look at points.
Because that's more interesting to see the big ones that are driving it. So as we wait for a change on points,
Come on, Joe.
Come on, Joe, in the control room. You do have some of the tech players doing pretty well today. If you change it by points, you will see some of the more economically sensitive type companies. Let's just go to the losers because Robinhood's at the top of the pile, again, based on percentage change, not on contribution to the S&P. It is down. Well, there you go. It's still down there. Now that we're looking at points, it's down 10% after an earnings where crypto looked weak, disappointed. And at the same time, Amazon, Microsoft, those are up there too. Netflix is down. Some concerns about activist investors saying you should take the Paramount deal. So those shares start to slip a little bit. Let's look at the sectors because you will see a lot of the economically sensitive sectors, and indeed most of them doing well today after really strong jobs figures. So energy does well, industrials, materials, infotech is having a good day. The only ones that are down at this moment, Matt, are healthcare and communications.
Communication services, those are the hyperscalers that I want to ask Dan Ives about, and I will do that on the other side of this break. Wall Street's new AI trade is sell the disrupted, but Wedbush's Dan Ives says not so fast. We'll talk to the big bull on his call next. This is Bloomberg Open Interests. Wall Street has a new AI trade, dump anything that's at risk of disruption, Wedbush's Dan Ives has a more nuanced take. He says to use the sell-off to focus on Microsoft and Google as weaker software and wealth names slide. Hyperscalers are committing over $650 billion in AI infrastructure capex this year alone. Dan joins us now on set to talk about his call. Dan, great to get some time with you. This has been the SaaSpocalypse. Did you coin that term, Dani?
I wish I did. I did not coin it.
Okay, so I hear it from Dani all the time. But I guess we've seen, little press releases from Anthropic drive hundreds of billions of dollars in sell-offs. What do you make of that?
There's a better chance of me beating Elia in figure skating than ultimately Anthropic taking out the software index. I mean, to some extent, look, the hearts and lungs of AI are going to be the use cases. So when you look at ServiceNow, Salesforce, they're going to play instrumental roles in the AI revolution. I mean, I can make an argument like a ServiceNow will be incrementally bigger in the next 2 or 3 years than they are today because of AI. So I just think there's a view. It's a knee-jerk. Look, on the edges, is it going to disrupt? Yeah. But I think right now, this is the Armageddon-like trade, the way software is selling off. And in our opinion, like in my career, going back to the late 90s, like it is the most head-scratching structural sell-off relative to what I believe is going to be the opposite as it plays out that I've ever seen in my career.
Not really head-scratching, because I think if I was running a big company and I had access to amazing AI, I would say, listen, chatbot, look at my CRM software and make a better copy of it, so I don't have to pay for it every month.
Look, and that's in theory, okay, from a high level, that makes sense. But the reality is, let's take a Salesforce, the hundreds of thousands of customers they have. You're talking about decades of data, how instrumental they are to come. A lot of times, if you're an outside vendor to get in, just based on security and infrastructure and everything, it takes 2 years to even get a demo. So I think there's a view, is it going to be disruptive? Yeah. But I also think in my opinion, it's about the ripple effect. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across software infrastructure. That's why my view is like Microsoft, Oracle, you look at Nebius, you look at some of the infrastructure plays. I think what we essentially are going through what I'll view as almost like a DeepSeek type moment in tech. And I view it as more of the golden buying opportunity given the CapEx, given the spending. I feel more convinced about the thesis today than I did before earnings.
There has been this other argument about spending, but specifically from corporate clients who are now just spending more on AI. That's what they're focusing in on. Everyone's trying to grapple and figure out how they make their company more proficient, more better, kill costs. And that comes at the sake of spending on enterprise software. Do you think that's fair?
No, I think that is fair. And that's why in the near term, it's a headwind relative to 67% of IT budgets right now have to have some sort of AI focus. But my whole point is that as the use cases play out, and we've seen with Palantir front and center is really the one that's almost been the poster child. I think you'll see with Mongo, Snowflake, and others, they will play huge roles in the build out, because I don't believe the AI revolution will not get to the heights that we believe it will without software, without infrastructure, without Microsoft, without Oracle. And that's why, I think some of this nerves here is, I think it's misguided relative to when we look at this year. This is going to be viewed as more the opportunity to own some of these winners rather than the time there was a structural sort of short.
Dude, my phone is blowing up because of your outfit. Viewers love it. Well, absolutely love it. And
I actually thought I thought we were going to match, but I guess I never got.
I wish.
He came in wearing something similar.
I'm on board. Listen, I wanted to ask you about the hyperscalers, the business model changing. It's not asset light anymore. They're spending a ton on, obviously, the data centers. But Katrina Dudley had such a great answer that I'd rather ask you about that. I mean, her take is they're just digging a deeper moat with every $1 billion of CapEx they're spending, and that makes a lot of sense.
It's an arms race. I mean, The reality is you're building Vegas 1950s from the ground. You're building Dubai from 25 years. I mean, you're essentially building new cities, new infrastructure. Big tech right now, they're not going to slow down. That's why you talk about $700 billion, what ultimately will be $1 trillion spent. And that's why they need to do this, because if they sit back and watch from the stands, then they'll be out of a fourth industrial revolution. We're only in year 3 of an 8 to 10 year build out.
So when there is disruption coming, is it from them or is it from AI startups? Because some of the sell-off we've had, I think there was like a tax strategy AI startup that just announced, and it made Charles Schwab and other stocks like that sell off. Are they the disruptors, or is it these foundational models, the hyperscalers, that are going to be doing the disrupting?
Look, I think it's a combination. I mean, it's my view. Like, look, for the first time in 30 years, the U.S. is ahead of China when it comes to tech. So this is going to be a time of innovation in this country in terms of startups, in terms of the hyperscalers, in terms of what I believe is going to be also a lot of M&A as it plays out. You're going to go through white knuckle moments like we're seeing over the last few weeks. But when you look at earnings, you look at CapEx, it's like follow the yellow brick road, follow CapEx. As CapEx continues to increase, that's bullish for the tech trade. And those derivatives, you could argue, are going to go into energy, financials, healthcare, as it plays out in terms of broadening market.
I just want to call out a client from my Huntington Bank, writes in and says, tell Dan Vernon Reed from Living Color called and wants his jacket back.
I like.
It's the cult of personality, bro.
Look, I mean, and this is, look, it's one like we dress the way we call stocks, maybe a little unconventional, but again, it's like, you know, it's one like, it's adding some colors to this AI revolution.
I literally want to put in an order for that blazer.
You can. If you go to danivesclothing.com. So
Dan Ives from Wedbush Morgan. Always awesome to have you on.
Great to be here.
Thank you, Dan, as always. I wish we could continue this conversation, but we have to head to break. And after the break, Nike betting on new products to fuel its comeback. Will they be as colorful as Dan Ives' clothing line? We're going to bring you an exclusive interview with Nike CEO Elliott Hill in Milan. That's next. This is Bloomberg.
The CEO of Nike, Elliott Hill, says he expects the company's wholesale business to pick up steam across the world. He spoke exclusively with Bloomberg's Romain Bostic during his visit to the Winter Olympics in Milan on a wide range of topics, including opportunities in the outdoor market.
By the way, it's not just trail running, it's the overall outdoor industry, if you will. And there's no question that there is a movement to getting outdoors, and whether it's in China or in Europe or in the United States. And so we looked at the overall outdoor market and the opportunity that exists there. And there is some crossover, but it is incremental opportunity from a branding and positioning and a revenue perspective. So we decided to go after that through the lens of trail running, which is a point of strength from us, where we can bring innovation to the market and newness and freshness, and decided to do it with the ACG brand because there is some awareness already around that brand, and it has an attitude and that we think is new and fresh, and it brings something different to the outdoor market. So we're really excited about what ACG is going to do for us long term.
So we're going to see more products from this line.
No question. You will see us continue to invest in the ACG brand. It's going to be around design, protection, attitude, innovation, and you'll see us extend beyond trail running moving forward.
I'm curious though, ACG's been around for a long time. It started out as a performance brand to a certain extent.
Top of the mountain.
Top of the mountain. A bunch of K2 climbers who for some reason decided to do it in a pair of Nike sneakers, and they sent it back to Nike, said, look, here's some feedback, here's how we can make this better. But ACG's been through some fits and starts, and I am curious as to why there hasn't been that continuity in the brand. Was it the marketing of it? Was it the innovation or lack thereof? What?
You know, I think with anything, it comes down to positioning, and I'm really excited about where the team's going to take this brand. We're going for the wild ones. So you think about the outdoor world with a little bit of an attitude and a swagger, with an element and an approach around design and innovation. And so again, I'm excited for what the team has come up with and the positioning and the opportunity that lies ahead.
That was Nike President and CEO Elliott Hill speaking exclusively with Bloomberg's Romain Bostic, who is somehow at the Olympics in Milan.
How do I get that job?
That's pretty good.
It's pretty good.
He managed to wrangle that, and I'm proud of him.
I'm proud and quite jealous.
Coming up in the next hour, we'll discuss the gaming outlook with Hasbro's CEO, plus Kevin McCarthy joins us on his new role in defense. "30 minutes into the trading day, welcome to Bloomberg Open Interest."
That's Matt Miller. I'm Dani Berger. We are just about 20 points away from a new record on the S&P, thanks to the data we got this morning.
Yeah, it's Jobs Wednesday, and we had a blowout of a report. January payrolls were double the estimates, and the unemployment rate actually fell.
And the magic behind Hasbro's return to growth. We're going to speak to CEO Chris Cox as sales soar at the toy maker.
Plus, money and politics. Former House Speaker Kevin McCarthy talks America's next wave of defense investment. Very much looking forward to those interviews, but it's really the jobs number, Dani, that we have to focus on in terms of market drivers.
For sure, because it has changed the direction of what we're seeing. Both equities move up, bond yields move up too, after stronger than expected payrolls reports. Pierre, Yared, acting chair of the White House Council of Economic Advisors, weighed in on the data in the last hour.
Not only is it total jobs that are up above expectations, it's also private sector jobs that are at 170,000, so more than, or 160,000, which are more than double expectations. I think the way to think about the way we were thinking about it is if you look at demographic changes as well as the big reduction in immigration relative to, in particular, illegal immigration relative to what was happening under the Biden administration, those two factors should lead you to lower break-evens.
Joining us now is Omair Sharif. He is Inflation Insights founder and president. Omair, I'm first of all grateful to have you on because Dani and I read your notes as soon as you put them out, whenever you do, and you follow inflation closer than I think anybody in these markets. What did you think of Pierre Yared's take that inflation is indeed getting better and not something that we have to worry about anymore?
Yeah, I'll take the other side of that. I think when you think about how much tariffs have affected inflation this year, even if you sort of take them away from the calculation, you're still not close to the 2% target just yet. There's still a lot of wood to chop. And I would say if you kind of think about, some of the assumptions people have about 2026, inflation is going to move lower, we're going to get closer to 2%. They basically are centered on three things. One is, tariffs are going to kind of go away. We'll have a base effect on tariffs that'll help us. Housing is going to keep going down, and that wage growth has slowed. And so the labor market is actually going to put less pressure on inflation as well. I've sort of got a counter to all three of those, but my ultimate feeling is that, we finished the year at 3% in 2025, which is exactly where we finished the year in 2024. We've made little to no progress, and I just don't see a lot of progress coming in 2026 either.
What does that mean for the outlook for cuts? Because we're still pricing them in. We've pushed them back a month after this latest jobs data, but would it then be a mistake for the Fed to undergo and continue a rate cutting cycle?
Yeah, look, I think it's much more, the Fed's rate cut outlook right now is obviously much more heavily weighted toward the labor market than it is to inflation. Today obviously was a surprise to the upside, but let's not forget jobs were revised down to an average gain of 15,000 for all of last year. That's, and I know that's in the rearview mirror, but that's sort of, to me, the starting point. If it gets much worse from here, I don't think they're going to want to see the labor market soften much further. So I think that's much more kind of on the front foot for the Fed. But if we do end up with a labor market where the break-even pace is, let's call it 30 to 50, 30 to 75K, we're in that ballpark, then I think the inflation data is probably going to be sort of pushing against the idea that you should be penciling in 2 or more rate cuts for this year.
What do you think about the idea that we're getting so much stimulus here from the government in the form of higher tax refunds? The president wants to actually cut real stimmy checks for consumers as well. Plus, you've got all this spending on AI data centers and a weaker dollar. Do we see inflation pick up even further this year?
To be honest, I don't know if it picks up a lot further. I'm, not really on board with some of the stimulus argument, in part because a lot of it's really front loaded to, the first couple of months with the checks coming through, higher refunds. That might help to goose certain sectors of the economy. Used cars is a good example. We're already starting to see wholesale used car prices pick up a lot earlier than they normally do. And that could help that particular market, which would help to boost inflation in the spring. But a lot of it is pretty front loaded. And in fact, if you look at some of the estimates from Brookings, for example, net, there's not a heck of a lot coming from the stimulus side. So to me, it's less of this idea that we're going to get a big push higher onto inflation to, let's say, to 4% this year. It's more that I think we just have a hard time getting down to the target of 2%. And we sort of essentially are just going to move sideways, despite the fact that a lot of people think tariffs and housing and wages are going to push inflation lower.
Well, I guess averaging is out the window, right? We're not going to average 2% anytime soon unless we undershoot for a while. Look, The Economist always argues that if we actually get stimulus checks, you've got foreign goods coming in with higher prices because of tariffs. We're going to take that revenue from tariffs, give it back to the consumer to go and buy more of those foreign goods coming in. Like, it seems so circular.
Yeah, no, it is. It is a bit circular. But I would say, by the way, when we talk about tariffs raising the prices of these goods that are coming in, I think we've only incrementally seen that so far. In fact, I would say so we have CPI on Friday. That is a pretty big number, not just because of sort of the start of the year price increases we tend to see, but my guess is we're going to see companies just sort of, try to sneak in some tariff-related price increases that they weren't able to push through last year into the January data, and that could potentially lead to an upside surprise on the core rate for both January, but I would say also we've got to be watchful of February. So I don't think the tariff story is quite over just yet. I think a lot of people are banking on this idea that we got a lot of tariffs coming through last year. I actually think there's more, left for companies to pass through. I mean, take the automakers as a good example. We know their cost rose for everything last year. They barely raised prices except for maybe, one trim and one model here or there. Now what we're starting to see is destination charges are starting to go up. Base prices are starting to rise. That's one sector of the economy where we sort of didn't see any tariff pass through. If that starts to materialize, that's, again, just another headwind for inflation going down this year.
Could anything go right? What is the scenario in which we do continue to see inflation move down, or is that completely out of the question?
I don't think it's out of the question. I think the big thing hanging over everybody is the IEEPA court case. And so the idea is if you suddenly rescind all of these tariffs, even if the administration comes through with, some temporary tariffs, let's say Section 122, they could put on a 15% flat tariff rate for the next 5 months. Once that goes away, do companies start cutting prices? Now, I think generally speaking, they're much less likely to do that than they are to raise prices. But I think that's one risk to the downside is if they decide, whether it's the affordability push, whether it's, consumers being more picky about purchasing items with higher costs, that's something where we could start to see prices decline, or at least rather, some price cuts later on in the year if the IEEPA court case basically says that the president can't use these emergency powers. So that's, I think, one thing to be on the lookout for. But again, beyond that, I'm personally a little hard-pressed to see, some of the arguments that folks are making for more disinflation this year.
I wonder what your take is just generally on AI, Omair, and the increased productivity we may see from that. It affects, obviously, the labor force, but also inflation.
Yeah, well, that's exactly the problem. Is that's sort of a double-edged sword. You've got the productivity gains on the one side, which potentially could bring down inflation, but then you have the very real potential cost to the labor market on the other side. What I would say is I think this, we're sort of like, if you think about it in baseball terms, we're probably in the first or second inning of this. Productivity data is revised years out into the future. So it's not clear to me that we should really be banking on productivity gains just yet as something that's going to be bringing inflation down, at least in the very near term. When we think about the 26 outlook and rate cuts for the Fed for 26, I'm not sure that I want to hang my hat on the productivity story being something that's going to be, very compelling for the Fed.
Omair, you are truly the best on this. Please come join us again. Thank you so much, Omair Sharif of Inflation Insights. Let's get a check on your equity market this morning, about 40 minutes into your cash equity trading day. Some of the gains have been slowing. We're now up just 0.2%, but notably there are gains there, about 0.25% for the NASDAQ as that outperforms, even though yields are moving higher. Good news is good news again, apparently. Yields for your 2-year are up nearly 6 basis points. We're at 4.17 for your 10-year yield, up 3 basis points after strong jobs data. Coming up, Albion River creates a new defense platform and recruits a board that includes former House Speaker Kevin McCarthy. We're going to speak to House and Ignium CEO Darren Farber. That's coming up next on Bloomberg Open Interest.
Let's get to high interest now. Look what's making headlines around the world. Israeli Prime Minister Benjamin Netanyahu will meet with President Trump in the next hour, where he's expected to press for a hard line on Iran's military buildup and ballistic missiles. He fears Washington could settle for a limited nuclear deal as U.S.-Iran talks begin amid mixed signals over what concessions the White House will demand. Lululemon employees are being warned bonuses will likely miss targets as sales growth slowed and competition heats up. Shares are down over 50% this year, and the company is facing leadership uncertainty, activist pressure, product missteps. It's on track for its weakest annual growth since going public in 2007. And defense private equity firm Albion River is merging several suppliers into one new platform called Ignium. It's being backed by a $300 million equity raise and a board member a board that includes member Kevin McCarthy, former Speaker of the House. The company will focus on boosting production of key military components as U.S. and allied defense spending continues to rise amid escalating geopolitical tension.
And let's get more on Albion River's new defense platform. I'm pleased to say joining the show now is Kevin McCarthy, former Speaker of the House and Ignium board member, alongside Darren Farber, Ignium chairman and CEO. Thank you, gentlemen, both for joining us. Mr. Speaker, if I can just start with you, because I think a lot of people are interested to see your name tied as part of this deal. Why join the platform and why this mission now?
I'll tell you, since I left, I had a lot of companies come approach me to be on boards, and I've turned most everybody down. I'm very selective. And this company, I had known Darren for quite some time. I've seen their success. It's important in this basis to know this isn't a company I'm joining because they offered me a board position. This is a company I invested in. This is a great need, not just for the country, but around the world. We've already have almost 1,800 employees, millions of square feet. We're producing items in the defense industry itself. And I just think the supply chain is so important, and we're poised at the right place at the right time to resupply that and to have tremendous growth with this company.
Let me go to Darren here on set with us. I'm always fascinated by the etymology of words, and ignium comes from the Latin for a fire. It's, I think, even more interesting than that. But if you strip away the branding, what are you actually building here? Because it strikes me that you're aiming this platform at a specific bottleneck, to solve a specific problem.
Right. So, there are, I think, two ways have been kind of popularized, right? There are existing primes, right, that we all know, Lockheed's and Boeing's. There are what we call neo-primes, these new startups like Anduril and what have you. But we feel there's a third way, which is to invest in the industrial supply chain and radically expand the capacity. And so our goal is to look at the rate-limited pieces of the supply chain and then add capital and really kind of blow out the production so they aren't rate limited anymore. And so we think of it almost like organs of a weapon system, if you will. So the brain will typically be made by a prime or a neo-prime, but we'll make maybe the heart or the lungs or the liver.
And your customers in this case, we're just looking at this full screen, aren't just the Pentagon, it's NATO too. But this is an administration, and we'll be curious to hear the Speaker's take on this too, it is an administration that's very concentrated on the U.S. and making sure we have the weapons, maybe before allies who need to take care of themselves. How does that change how you approach customers and who you're ultimately catering towards?
Sure. So we view ourselves as catering to the Western world at the end of the day, and increasing capacity in the system to be able to furnish kind of the entirety of the allied world reduces cost and provides a better value for the taxpayer and the Pentagon. So our goal is to sell to everyone that's fundamentally aligned to the United States. The fulcrum we start with is the U.S., right? We're American. We support the American mission at the end of the day. But to get better cost value and scale, you must sell to more than just the United States. And so our goal is everyone that's aligned to the United States should also be a customer.
Mr. Speaker, you've said that the level of trust across the Atlantic is enormous, but this is an administration that does not trust its NATO allies. President Trump has said himself he's not sure if they would come to our defense in case of a problem. And with an advisor, Stephen Miller, who has essentially threatened war against NATO for Greenland. So how do you see that trust evidenced?
Look, I spent a lot of my time with foreign leaders, a lot of them a good relationship. If you look at what this administration is asking for is NATO to do more. NATO has admitted they need to do more, and they're actually putting their money where their mouth is. They're investing to a higher level to build those weapons that they need. They want American weapons. If you look at this company, we're poised at the right place. Some of our manufacturing is sitting in Europe as well. So I think you're going to see a greater growth. And this is exactly what the Pentagon is asking asking for. They want to see improvement. They want to see supply chain improvement. Darren and I have been to the Pentagon. I think you're going to find with this company, the organs that we're able to provide, expanding the supply chain and helping those allies do exactly what President Trump is asking for, to spend more money on defense so you're not always relying on American troops. You're able to defend yourself. This is exactly poised where we should be.
Speaker McCarthy, part of the push from the Trump administration, too, has just been a much more interventionist approach. So it's not only asking for these things, but from American defense companies, it's pushing back on things like dividends and buybacks and on executive pay. Is that the price of just doing business with the Pentagon now? Is that a healthy environment for defense companies to be operating in?
I think what the new administration is trying to do here is they're spending more money on defense, but they want more primes. They want more people doing the work. They want to have a better cost in the supply of making it happen, but they want it to happen faster. That is why when you look at the defense industry, they have much more investment, and this company itself is in the right place, I again say at the right time, for where we want to shift this Pentagon to be able to be to ramp up the supply chain. We're going to be an integral part of that.
Darren, outside of the politics of it, how will you deal with running this company that has international production, international footprint, especially as we hear, USMCA may be torn up. You've got production overseas, as you said. Do you move it back here? Do you change costs? What's that look like?
We manufacture in the markets that we serve at the end of the day, and so I don't view it at cross purposes to have, you're very fluent in German. We have an enormous facility in Bremerhaven, for example, and that's a core pyrotechnic facility for Europe, but. We'll manufacture in the geographies where the product is fundamentally needed at the end of the day. And so I don't view that as cross purposes to what the United States needs. The United States needs to have, its entire, domestic production capacity. But look, in businesses, the interconnectivity between European and American businesses versus, let's say, the interconnectivity of politics, businesses is much higher. Think about ASML. We rely on them almost exclusively for photolithography and chips. And so, all that technology, all that collaboration at the end of the day only helps us to increase U.S. production and then ultimately drive prices for sub-assemblies lower.
So what tariff costs, if any, have you been having to take on?
We haven't been taking on many, quite frankly, because we manufacture and we operate in the geographies that we're in. There are certain parts of the supply chain, like batteries, for example. This is a known problem where almost all the cells come from Asia. And so there's a push now to get cells made in the United States. And that will take it will take a pretty meaningful effort at the end of the day. But you can never bet against America, right? Once we're galvanized and once we're organized, there's this enormous momentum that helps us deliver the industrial capacity.
Mr. Speaker, it strikes me that we are we're not at war, but we're getting closer to a wartime footing, building up things like Project Vault, for example, and making sure that we have businesses that are really important to national security here in the U.S., like chip production. Are we getting, you think, into maybe even a multi-decade rebuild, industrial rebuild, similar to what we saw at the beginning of the Cold War?
I think you're seeing what you had in the 1980s, peace through strength. And you also have to take the successes of the Silicon Valley. You've got to look at a different place. We can't be dependent upon China. I think that's what the Pentagon is looking at, the supply chain, especially with the critical minerals. But you also have to have the integral organs to be able to make it happen. That's why this company is so successful at where they've been so far. But if you're also relying upon a very small business, how do you ramp up? How do you scale up? This is where we can come in to help the Pentagon at the same time. So this is really a retooling time period. I think it's smart what the Pentagon has been doing. It will keep more peacetime. And one little known fact you have to realize is this is the longest time we've been at peace for between a great war since the Roman Empire. You've got the building up of the Crinks now. You've got the war in Ukraine. This is not a time to sit back and think everything's fine. This is a smart move with NATO to build up stronger so there is not further war. It's smart for America to go out to not be dependent upon China and to be able to have a new form of a Pentagon that can do things faster technologically and be able to have a supply chain that's there for them.
Darren, what are your constraints? What are your biggest constraints right now, especially here in the U.S.? I'm thinking of raw materials. Obviously, critical minerals are important and tough to get hold of, even for car manufacturers. Of course, for defense, we have a different infrastructure for that. But also, labor must be difficult to get in the U.S.
Labor is not easy, right? Especially for these highly skilled engineering positions at the end of the day. But we work cooperatively with a lot of technical schools and trade schools in order to get the people that we need. Another rate limiting factor is the visibility that Congress provides. And so continuing resolutions by law prevent new starts and new programs. And so the more Congress can give longer duration visibility to the defense industrial supply chain, you'll get it. And we're seeing changes in legislation like multi-year authorities. This has never happened before, by the way. So multi-year authorities for things like ordnance, that never happened before. And so there's a change afoot because folks recognize that we need to plan in a much longer cycle, what we call a quadrennial, so at least 4 years, if not more.
Well, then it's probably extremely helpful to have someone on your board who knows the inner workings of Washington, D.C. very well. And Mr. Speaker, on that note, what conversations have you had with the folks in Washington, D.C.? What have you asked for them when it comes to Ignium, and what's the sort of response you've heard back?
The great part is I don't have to ask anything. The Pentagon is out there trying to find a better supply chain. We are an avenue to actually help. And if you look at the rest of the board, look at who's being a part of this. And every single board member has come on first as being an investor. Greg Brown, one of the best CEOs in America when it comes at Motorola. And you watched all American-made products. Greg Smith, formerly with Boeing, you watched Intuit and others. This is one of the best brain trusts to see the transformation that we need to come to the Pentagon. You can't rely on a few big suppliers. You've got to be able to bring that Silicon Valley technology. You've got to have a good supply chain. You can't be dependent upon other countries. You've got to have the peace through strength. This administration is retooling the Pentagon. They've invested heavily. If you look at the investment Congress has recently made, but they want their money to go further, and we're going to be able to help not only America, but the Western believers in democracy to be able to have the strength against those who try to oppose us.
What's your take on the current funding struggle in Washington, Mr. Speaker? The Democrats have a list of demands, including unmasking ICE agents. That's a fairly new thing, that American police forces would wear masks and be anonymous. On the other hand, the Republicans say it's a sticking point they won't move past and could result in a government shutdown, at least a partial one.
Well, let's think about this. Let's give the Republicans the credit. They have funded government, like 96% of it. And the Democrats are really arguing about the wrong point. ICE is already funded. What the Democrats will shut down will come to be the Coast Guard, FEMA, when Americans need help in disasters. That's the funding they're holding up because ICE is already funded. And if you want to talk about a mask, it's really trying to influence and threaten law enforcement. And I don't think that's right. But I think we need cooler heads. We need to find common sense. I mean, I take a great deal of pride if I'm one of the few speakers that never had a shutdown. We were able to make sure that we had government funded all the way. And you can't keep funding government by continuing resolutions. They did all 12 appropriation bills, something that hasn't happened in decades. And then the Democrats at the very end held up this small portion. But it's not about Homeland Security. It comes down to FEMA, the Coast Guard, and also when it comes to the transportation of our airlines. Those are stupid things to play games with because we want the safety of America to go further. I hope common sense prevails in these last few days to get that funding through.
I know a lot of the American public are upset with some of the images they've seen have been pushing for Democrats to do these measures too. Unfortunately, we're going to have to leave it there. Thank you both so much for joining us, former Speaker Kevin McCarthy and Darren Farber of Ignium. By the way, catch my new show, Bloomberg Deals. It will air today, Wednesday at 12 p.m. More on Open Interest coming up next.
Hasbro's turnaround is gaining momentum, powered by a surge in Magic: The Gathering. Revenue from the popular card game more than doubled in the fourth quarter, boosted by by its tie-ins to other products such as Avatar, The Last Airbender, and Final Fantasy as well. Strength in Hasbro's Wizards of the Coast and digital gaming division, which holds Magic and D&D, helped lift overall sales 14%, underscoring what the CFO, Gina Getter, called a year of strong operational execution. Joining us now for more insights is Hasbro's CEO, Chris Cox. And Chris, you're essentially, the designer of this business as it is structured right now. What do you make of the quarter? Give us your overview, because it looks like Wizards is just absolutely crushing it.
Well, we're really pleased with the quarterly results, and I think it's beyond just Wizards. Our licensing business is up. Our toy business returned to growth, growing 7% in the quarter. And then, of course, Wizards had just a remarkable quarter and a remarkable year, sequentially just growing more and more as we went through the year. And we're seeing that momentum continue into this year. I think the year was really punctuated, as you kind of said in the lead up, by Magic the Gathering. That business is over $1.7 billion now. It grew nearly 60% last year. And that's on top of a CAGR over the last 10 years of 16% per year. So I think it's a testament to a great team. I think it's a testament to a great game and a fantastic fandom.
There has been some signs, not you necessarily, but Mattel earnings, retail sales, that there was weakness in December. I know when it comes to divisions like toys, you have, which I'm sure one Matt Miller's already bought for his daughters, tie-ups with things like K-pop Demon Hunters. What did December look like specifically for that segment? Was there some weakness that we've seen elsewhere?
Well, I think for us, what we saw was a sequential improvement as we went through the holiday. We had a great Black Friday and Cyber Monday. There was a little bit of a dip in like the first and second week in December, but then the end of the month ended with a real bang. For Hasbro, our toy division grew share, I think 18 of the last 20 weeks of the year. And I think that was on the strength of really good entertainment and really quality toys. We had a great year for Beyblade, Transformers, Marvel. Our Peppa Pig business returned to growth in the back half, and then our board game business did pretty well. What I think maybe you're seeing across divergent results across different toy companies is really, it's tough to say there's one toy market. I think it's a tale of two cities. I think the companies that are focused on gamified, entertainment-driven, multi-purchase, multi-generational play, something we call Gem Square, or a lot of people use shorthand for kidults, they're really thriving. Their multiples are strong, 20 plus. Their growth rates are in the mid-single digits to high single digits. And they're growing with the growing marketplace. I think toy companies that are focused more on traditional toys, toys aimed at kids, kind of one-offs, not truly systematized, that's a hit-driven business without a very strong moat. And I think you're seeing it in terms of what their multiples look like and contraction in that business.
By the way, I read about at least five Peppa Pig books last night.
Are you a kidult?
No, I object to that. I object to that turn of phrase. But I get what you're saying, which is that more and more people, Dani's age or even my age, are buying and playing these kinds of games, especially Wizards and the digital games. Does that help to offset business that's maybe hurt by tariffs, Chris? Because it strikes me that those businesses, the cards and the video games, aren't as hurt by the taxes on imports.
Oh yeah, I mean, for sure. There's a couple things at play. First off, those collector-oriented businesses, gamified and adult-oriented businesses, tend to not be tariff exposed. Magic the Gathering, the majority of the product that we sell in the U.S. is printed in the U.S., so there's no tariffs associated with it. Digital games don't have tariffs because they're made and published here in the U.S. for U.S. audiences. So that really helps. And then last but not least, because you're dealing with audiences that, 20, 30, 40, in my case, 50 years old or more, they tend to have a better personal balance sheet, They tend to have, less elasticity of demand. And so you just have a bit more pricing power, even when you have to take prices if there's something that's tariff exposed. With kids, you tend to be dealing with families on budgets. They're pinching pennies a little bit more. Parents are always going to prioritize their kids, but there's only so many dollars to go around during Christmas or a birthday. So, I think, 70% of our business, maybe upwards of 80% of our business are focused on that collector gamified business. And then moving forward, probably 90 to 95% of our investment are focused there. And I think that's what investors are appreciating today about our story.
So if that's the case, and the success, Chris, are you going to be making more Magic the Gathering video games?
Well, we have Magic the Gathering Arena, which has been a very successful product for us. It's probably the most successful onboard to Magic. We will be continuing to invest in that platform. And certainly, we have probably 10 games in development. Magic is certainly an important brand for us inside of that pipeline.
I wanted to ask about your move. I visited you guys. I was lucky enough to go to Wizards in Seattle, and I also came up to your place in Pawtucket, Rhode Island, my first time in Rhode Island. But you're moving up to Boston, or you've moved up to Boston, Massachusetts. What drew you to Beantown, and what do you make of? I guess there are different tax treatments and different politics there. So how have you settled in?
Well, I'd say politically there isn't a huge difference between Rhode Island and Massachusetts, so that wasn't a real factor for us. Hasbro has deep roots across New England, particularly in Massachusetts. Milton Bradley was founded there back in 1860. Parker Brothers was founded in Salem, Massachusetts, I think, back in the 1890s. So we're no strangers to Boston. Really what we were looking for is a bigger market in terms of the number of people that we could recruit. Boston is roughly 8 to 9 times the size of Pawtucket and certainly Providence, where we've been based. And then it's just easier access. A big part of our business is partnership. It's partnership with retailers. It's partnership with licensors. We have over 1,000 partners crossing 5,000 collaborations. And it's nice to be in a major travel hub like Boston because it just makes it easier for us to be accessible and easier for us to get to our partners as well.
Chris, by the way, is no stranger to Boston, or I should say to Cambridge.
Okay.
Right, because he went to Harvard.
Oh, never
No
heard
big
of
deal.
it.
No big deal. And by the way, he played football at Harvard. See, I used to think Magic and D&D were like games for nerds. But I meet people like Chris and Gina Getter, who used to work at Harley Davidson. I met like the strongest man in the world in Seattle, who is like the head of their Magic division there. So
my cousin loves Magic the Gathering, and he is awesome. Which, by the way, doesn't mean that you're not a nerd, Chris, because nerds are fantastic and wonderful people. So I don't think we should brandish that label. Hey, just before you go, on this topic of Rhode Island versus Massachusetts, because Rhode Island at the moment is debating this millionaire tax, something that Massachusetts already has something similar. As a CEO, how do you feel about that? Does it change at all the business environments, or is it something you support? How do you think about that?
Well, I try not to make business decisions based on my personal finances or personal situation. Moving to Boston had a lot of talent advantages. It had a lot of transportation advantages, and it's just a big dynamic city. So that's really how we thought about that. We actually have a dual HQ, so Boston is one side of our HQ, Seattle's the other, and that just represents kind of where our business is. Boston really anchors toys and licensing, and Seattle anchors our gaming business.
Hey, Chris, we really appreciate your time today. Hasbro CEO Chris Cox, please come join us again soon. Let's get a check on your equity markets this morning, more than an hour into your cash trade. And we have turned negative. We are down 0.1%, and it was the NASDAQ leading us higher. Now, interestingly, it's leading us lower. We're down 0.2%. Maybe it is higher yields math that's finally weighing on this equity market. We're up by 5 bips for the 2-year yield, just under 3 basis points for 10-year yields.
It's so interesting. We just continue to struggle. We get close to that, that record high, and we seems like hit a ceiling.
I wonder how much of it is structural, because remember Goldman Sachs had that note out basically saying all these trend-following CTAs are poised to sell. So maybe it's a bit of a trigger-happy algorithmic trading that's happening.
Yeah, a very interesting market to watch. By the way, when we come back, we're going to give you more of our exclusive interview with the CEO of Nike, Elliott Hill, at the Winter Olympics in Milan. This is Bloomberg Open Interest.
Nike CEO Elliott Hill says he expects the company's wholesale business to pick up steam across the world. He spoke exclusively with Bloomberg's Romain Bostic on the sidelines of the Winter Olympics in Milan about how his turnaround efforts have paid off.
There's no question, if you see where the stock we've held up over the 16 months, the focus on sport, the focus on growth, they understand then the portfolio that we have, 3 strong brands, Nike, Converse, and Jordan, the focus on sport and how we're segmenting each of the brands by sport, and then ultimately paying it off in 190 countries around the world is only Nike can do at the size and scale that we are.
But when I talk to analysts on Wall Street, they're relatively complimentary of what you've done, but they are still concerned about sales growth, which is still relatively flat. They're concerned about profitability, which to a certain extent is not quite there, at least not to their liking. When do you get there? When do you get there to a sustainable growth rate on revenue and, more importantly, generating more profits and wider margins?
One of the things that we've talked a lot about is what is the top line growth rate with our investors and the bottom line expectations, and we're confident that we'll be able to get there. We're confident that the sport offense is the path forward. Those 3 brands, a portfolio of brands, portfolio of sports, footwear, apparel, accessories, and then again paying it off in the marketplace. And so the newness and freshness is working. We had some proof points in the last quarter. North America being back to growth, which was a strong result for us. It's our largest reporting segment, running back to double-digit growth. And then, of course, our wholesale business, which is critically important to the future of our business to serve consumers wherever they choose to shop, also back to growth.
So running North America was up more than 20%. Overall, North America was up 9% across the board. I want to talk about the wholesale, though. In North America, that did great. I think it was roughly about 20% as well. But there's been some criticism that maybe the sell-in that you've done is maybe too heavy into North America and not necessarily broad-based across the globe.
The focus was across the entire globe in terms of the wholesale side of the business. I think the team in North America, led by Tom Petty, who's a seasoned veteran, he has the relationships.
Not the singer.
No, that's P-E-D-D-I-E for correction. But he has tremendous understanding of the marketplace, the consumer, and he and his team have done a really nice job getting back and with the wholesale partners and driving that level of growth. And you'll start to see that across the rest of the world as well. I'm confident in the leaders that we have in place and the desire for our retail partners to serve their consumers. We have a joint consumer, and they want access to our brands.
Is that relationship better with them? I mean, Nike gravitated away from those retail partners to a certain extent back in the early 2020s. I know they kind of tried to reset under Donahoe before you then came in. When you talk about being able to sell through Amazon or Macy's or whoever else here, they're comfortable with what you're giving them, selection-wise, price-wise?
Yeah, I think there's no question. We're having to pull a lot of our products forward and to really drive that innovation and that newness and freshness. I think we have an opportunity around depth that we're still working through to make sure that we have the depth to drive the revenue and profits that they expect from us. And we are committed to doing that because ultimately, when we're driving growth and profitability for our retailers, that's how we take market share, and that's certainly I think something that I am really challenging our team around is that growth, profitability, and then ultimately taking back market share.
That was Nike CEO Elliott Hill speaking exclusively with Bloomberg's Romain Bostic in Milan. The Olympics have been going on for, I guess, about a week now. I've watched maybe 15 minutes of curling.
Yeah.
Have you watched any of it?
I've done such a bad job of watching. I fear that I've become my worst enemy and someone who's like only seen clips on social media, and I'm disappointed.
But don't you care? I mean, you're a dancer, right?
Correct.
You're athletic.
The problem is I care, but I just like sleep more. Also, the time difference doesn't really work because it's happening in Europe, which is so much earlier, and we have to work during those hours.
It's as big of a deal.
Yeah, maybe I'm just lazy enough.
Although Lindsey Vohn's accident was
so
horrendous.
Bad. That was very bad.
Coming up, AI, speaking of breaking, AI is breaking into the real world, and Ouster's $1 million bet could power the next wave of smart machines. We'll talk to the company's co-founder and CEO next. This is Bloomberg Open Interest. AI is moving off the screen and into real-world machines, and Ouster is helping that transition. The company uses a laser-based sensing technology that helps self-driving cars see the world in 3D. Now the company is expanding beyond lasers, acquiring the camera tech firm Stereolabs in a $93 million cash and stock deal. The aim is to build smarter vision systems for robots, drones, and automated warehouses. Here to talk about how physical AI is shaping up is the Ouster co-founder and the CEO, Angus Pacala. Angus, great to have you on the program. Tell us, first of all, about all of these different systems that help essentially computers see. Are there any that stand out, or do they all have to work in conjunction?
Yeah, well, so Ouster, leading provider of LiDAR technology, one thing we've always seen is we have over 1,000 end customers, and one of the common problems that our customers have is LiDAR provides incredible superhuman 3D vision, eyesight for robotics across every different domain you can imagine, from automotive to smart infrastructure to robotics to industrial applications. But there's a common thread where customers still need the textural nuance and resolution of cameras in combination with LiDARs in order to interpret signs or QR codes or know the color of lights and not just the location of street lights on a street corner. And so there's a universal need for superhuman vision that combines LiDAR and camera technology. And this is what Stereolabs is all about. And to your question, it's not just about having the hardware reliable and safe and capable. It's also about the AI computers and the AI algorithms that make sense of all of this deluge of technology. So traditionally, our customers have had to buy two different, a camera, a LiDAR, computers, and AI algorithms from disparate suppliers and try to make sense of all that in software that they've rewritten time and again across, tens of thousands of different customers across the two companies.
So the technology, Angus, if I can just jump in, it is clearly fascinating, interesting, impressive, but what about pricing? I was speaking to an executive today who basically said, look, the big problem that Waymo has is that the way it's configured its car, the way it's set up the technology is just too pricey for them, and that's going to be an issue as they come to scale. As you're thinking about these innovative new technologies, how are you making sure that they're affordable enough to get them to consumers, to get them widely used?
Well, that's the name of the game, because Waymo is a great example of fusing LiDAR and camera to create something safe, reliable, and actually practical and scaling in the world today. So that is the perfect example of where we are taking the long tail of customers in this space. So and then the affordability is a key aspect of both Stereolabs and Ouster. Ouster invented a technology called digital LiDAR. We're putting LiDAR onto silicon chips that are cheaper, more capable, and more affordable. And that's just the beautiful march of silicon technology, is it brings advanced capability at affordable pricing, and that's something that Ouster has done great so far.
Angus, we don't traditionally produce those kind of goods here in the U.S. Where are you manufacturing the bulk of your product, and how are tariffs affecting you?
Well, the advanced semiconductors, those digital LiDAR chips, are actually produced at mainline Western fabs, companies like TSMC, ST Micro. So there's still a semiconductor base in the West, and those are our suppliers. We have some of the best companies in the world building our chips. We manufacture a significant volume of our products in Thailand with two American companies, Fabrinet and Benchmark. And we also have a Buy American certified production line here in California to ship to customers that prefer a Buy American certified product.
So beyond self-driving cars, where do you hope to expand into? What does the business growth in line look like going from here, Angus?
Well, I think Jensen Huang actually said it quite well. He said, everything that moves is becoming robotic. And so Ouster is a diversified strategy across automotive, industrial, smart infrastructure, and robotics. And we've seen a lot of excitement in the last year in the physical AI robotics space. So I was just at CES walking the floor, and you couldn't walk more than about 10 feet and see a new humanoid robotic. And guess what? humanoid robotics, they need cameras, they need LiDAR, they need AI computers, and they need the AI algorithms to make sense of it all. And that's what this acquisition is all about. It's combining all those technologies and creating a one-stop shop for companies like that to buy this technology off the shelf and focus on what they do best, which is training those systems for end applications, for working on an assembly line or working in your household doing chores.
The stock has done very well in the last year. It's doubled in the last 2 years. It's more than tripled. How are you funding this acquisition, and how are you looking to finance your growing business going forward?
Well, we've always been careful with our cash, and we think that the Stereolabs acquisition is great on the metric of just kind of the financial path that we've already been on. Ouster's on a path to profitability. We have a strong cash balance, and we've had 11 straight quarters of revenue growth. And Stereolabs is actually an EBITDA positive company that did 16 million in revenue last year. And so they're accretive to Ouster's overall path to profitability. So we've been strategic with acquisitions like that, making sure that we are laser focused on becoming a profitable public company in the next couple of years.
Angus, great to have you on the program. Really appreciate you joining us. Angus Pacala there of Ouster, speaking about his laser focus. By the way, did you know that Dani has a new deals show? It's today, and it's every Wednesday from now on at noon New York time. I'm very excited for the sophomore episode today, the second time only, but it'll continue because she has General Atlantic CEO Bill Ford. It's a show you do not want to miss today at noon.